Good morning. You're watching Business World Live. I'm Danie Laurel. It's the start of a new trading day. Let's kick off with our banner. Unemployment rose to a record high in 2020 as many businesses had closed or downsized their operations due to the health crisis. Preliminary results of the 2020 annual labor force survey show that unemployment rose from 5.1% in 2019 to 10.3% last year. This is equivalent to 4.5 million jobless Filipinos. This 2020 figure was the highest recorded unemployment rate since 2005. That's according to the Philippine Statistics Authority. Employment rate fell to 89.7% or 39.4 million people from 94.9% in 2019. In total, the number of persons who were in the labor force or those economically active population, either employed or unemployed, was estimated at 43.9 million. This translates to 3 in every 5 of the population 15 years and older were either employed or unemployed. Now, the PSA said the labor force participation rate is also the lowest since 2005, reflecting the effect of various community quarantines, business closures, and physical distancing measures that were put in place starting March of last year. Okay, guys, kicking off the markets report with a check on global equities. Quite a mixed trading day over in Wall Street overnight. You've got a rotation out of growth stocks. You can see that on my terminal here. So the tech benchmark, the Nasdaq 100, tumbled by almost 3% Tuesday. That was its lowest close since November and is now down 11% from an all-time high in February. Meanwhile, the Dow Jones hit an all-time high before that actually settled up by 1%. So I'm going to try and pull out for you guys the U.S. yield curve here. The U.S. yields have been in focus in terms of the bond yields really rising. So the U.S. benchmark is now trading at a 12-month high, and there are a lot of fears that the government might actually be pumping in quite a lot of aid here, especially with that stimulus plan of Joe Biden, and that might push the U.S. economy into overdrive and stoke inflation. And this is what investors are now questioning, whether the equity valuations have become excessive, particularly in those speculative tech shares, and are now favoring cheaper cyclical stocks. Now, this is according to Valerie Grant. She's a senior equities portfolio manager at Alliance Bernstein. She says there's a lot of volatility in the market. Many of the sectors that underperformed last year are rallying, and this is all part of the rotation. Now, let's take a quick peek on our own opening here. Now, recall that we took quite a beating in terms of our own index yesterday. That's after our country topped 3,000 cases for the third straight day. You also have a lot of reports in terms of occupancy rates in the ICUs of hospitals. You've also got Central Bank Governor Ben Diokno saying yesterday that the inflation, which is coming out, of course, on February, the new print, that might exceed target, and not just this month, but for the next few months before tapering off in the second half. And you can see us opening on the back foot here, down by a hefty 0.4%, 6,700s levels right now. A lot of the ones that had moved yesterday were really the mall developers, and I want to take a quick peek on whether they are still the ones dragging down the index. A bit of a mixed picture here. You can actually see the retailers gaining ground here. Robinson's Retail in particular up by 2.2%. But you do have on the downside LTG Group down by close to 3%. Bloomberry, which had just released its results there for 2020, which was worse than analysts had expected, down by 2.6%. And other such property players and mall operators, Mega World, for instance, down by 2.5%. Now, here to chat with us about this and the other latest moves in the market, we have with us Matt Cabangon, president of AAA Equities. Good morning, Matt, and welcome back.
Hi, Danny. Thanks for having me again.
Okay, Matt, what's happening here? You've got optimism offshore in terms of a general global recovery, even as rotation towards towards cyclical stocks, even. But here on the local front, you've got more and more pessimism. To what extent do you feel that this trend is going to be totally reversed, and the feeling that we've hit rock bottom might not actually be the case just yet?
Danny, it's very strange how last year we saw the economy worsen continually, but stocks were outperforming, and now it's the reverse. The economy's getting better, but stocks are doing worse. I think uh, the global markets, our market included, is now having a sort of wake up to reality moment where the recovery we were expecting last year wasn't going to be the smooth ride that we were expecting. So now people are looking at rising cases again. People are looking at how slow vaccines are rolling out, and now thinking, okay, maybe we were a bit too optimistic last year. This is going to be some sort of VU or whatever letter-shaped recovery.
Mhm.
So now we have complications right now. As you mentioned, inflation's coming up. So oil prices, food prices, unemployment's not getting much better. So yeah, we are sort of waking up to the reality that the perfectly that the perfect recovery people were expecting isn't quite working out
Just yet.
as they expected.
Okay, but Matt, what leads you to say that the economic recovery is underway? I mean, what indicators are you watching out for that leads you to think that it's actually been better than it was last year? Do you see that in the earnings, for example? Or do you see that in a anecdotal sort of point of view?
Well, I'm not looking at anything too fancy. I'm just looking at corporate earnings. We've seen corporate earnings improve quarter on quarter, every quarter since last year. Now, don't get me wrong, the numbers are still looking bad, especially now that annual reports are coming out. Um, but nonetheless, we are seeing improvements every quarter. I think the Jollibee earnings are my personal favorite. They turned a profit in Q4 last year, so I think that tells you a lot about the direction that the economy is headed. Now, whether or not we're going, there's no question that we're going in the right direction. But I think the question now is, are we going down that path fast enough?
Okay, you mentioned Jollibee. Let's take a deeper dive on that because that's your favorite earnings. Very interestingly, despite the fact that it was a loss that was better than could have been. It could have been worse, basically, according to some analysts. What's your outlook on Jollibee? Is this going to be a year they just recover those losses? Is there going to be any sort of growth here, especially since they're still integrating a lot of their acquisitions pre-COVID?
Yet, to me, although they have evolved a lot last year, focusing more on deliveries and fulfillment, they are still very much investing in new restaurants. So I think they, along with a lot of other companies, are expecting a back to normal environment, maybe in 2 years' time, rather than a new normal type environment. So I think for companies like Jollibee, for companies like mall operators, it's going to be a waiting game.
Okay, and what about the mall operators? So they were the ones that really moved yesterday. A lot of them have started reopening. You've even got SM saying that they're going to spend 80 billion pesos for the residential projects and mall projects this year. To what extent can they even afford this, given the massive losses that they felt over in retail? And how long is it going to take for them to actually get back all of this capex?
Well, if I were a mall operator or a mall developer or any developer really, I'm taking this opportunity as a chance to gain market share. Rates are rock bottom right now. Banks don't have any lenders to lend to. So if I'm a real estate uh, if I'm a real estate developer and I'm seeing all these opportunities, fire sales going on with deals, I'm going to be taking this chance to borrow at rock bottom prices and gain market share while my other smaller competitors uh, are having a tough time. So to me, it's no surprise that SM is really making this push despite the economy being in the place that it is.
But is it ever going to go back to that sort of foot traffic in terms of retail, especially given the fact that e-commerce has now boomed and people have a completely different lifestyle. People are even moving out of central business districts and into suburbs or wherever.
Yeah, I think that's a difficult question to answer. There's no doubt that online shopping and online retail is, I mean, that's going nowhere but up. But right now, online sales account for less than 1% of
Okay.
all retail sales. Granted, that number's only going up, right? I mean, online shopping is not going to be shrinking in the near future, even in the long term future. So, but the pie is just so large that I don't think SM's even thinking about online shopping for now. And if the day comes that they do need to branch there, they surely have the capital to develop that distribution channel.
Okay, Matt, is this the time, now that we are pulling back a touch and below 6,700 levels, is this the time to be re-entering the market? There was, this rally in speculative stocks, smaller stocks before, and now, as we mentioned in the report, there's actually a move away from those stocks, at least in the US, and back into the real economy. Is that going to be the same trend here?
Well, I would advise people not to catch falling knives. We're still seeing, even right now, very violent moves in some of these non-blue chip stocks. For example, like Dito, I think is down another 6% today, and that's been sort of a retail darling. But it's no surprise that it's the retail stocks that are moving so aggressively, just because that's where all the hot money is. All the volume over the last 6 months or so have been in these non-index stocks. So you would expect the sort of unwind of flows to be happening in the same names. So is it time to buy? I wouldn't say so. I would wait for the dust to settle a little bit and not catch these falling knives.
Speaking of Dito, let's talk about their achievable targets. How achievable is 30% of market share and this offering? They have unlimited mobile internet for 199 pesos a month. That seems quite unbelievable. But they did mention it's completely feasible. They're expecting to cover 84% of the population by the fifth year. Tell us, how does this bode well for their stock, and why did it actually slide yesterday?
Well, Dito, just like our broader market, is having that same realization that last year and the years before that, it was all sort of, it was all promise, it was all possibilities. And now that commercial operations are going, reality is starting to set in that maybe that what they're setting out to do is very hard. That the duopoly between Globe and PLDT is not going to be that difficult to. It's not going to be that easy to unseat. So I think markets are now having a sort of reality check, just like the broader market, that Dito's targets might be a bit too ambitious, and that the price might have soared a bit too high given how big the challenges are for this company.
Okay, so quite ambitious and still quite volatile for the time being. And finally, last question, Matt, before we let you go. What support levels are you seeing for the index if we do continue on this trend of rising cases, which some, health experts have said is bound to happen?
Well, the rising cases are a problem for the short to the medium term. If we see those numbers ramp up substantially, a testing of the 6,500 support level is surely in the cards. But I'm not too worried. Again, vaccines are really just around the corner. Even if we were to see a prolonged increase in cases, we're not going to be going back to the levels of lockdown we saw last year, just because the vaccine is here now. It's just a matter of delivering it and administering it. We're not waiting for one to be invented anymore. So if I were to see the market dip substantially below 6.5, I would start buying there.
Okay, it's exciting times to be entering, actually, as Matt Cabangon says that the market movements are disconnected from the economic recovery. Thanks so much for those insights, Matt Cabangon, AAA Equities.
Thank you.
Here are the other headlines we're keeping our eyes on from the Philippine Star. Bike imports surged last year. That's as the pandemic restricted public transport options in the country. Citing data from the Customs Bureau, NEDA said bike imports soared 112% to 2.1 million units in 2020. This is from the 1 million bike units shipped into the country in 2019. Acting Socio-Economic Planning Secretary Carl Chua said this shows more and more people are choosing cycling as their new mode of transportation. To further encourage this, NEDA has called on the private sector to contribute to the alternative transport movement by providing end-of-trip facilities such as bike parking spaces and shower areas for employees who bike or walk to work. The Department of Human Settlements and Urban Development is set to carry out more housing projects nationwide to help revive the economy. Housing Secretary Eduardo Del Rosario says housing and the real estate sector can help boost employment for thousands of Filipinos across the country. Following the easing of quarantine restrictions in June 2020, real estate activities slowly resumed. This caused 55,000 laborers to return to work. The DHSUD is targeting to provide homes for at least 81% of families across the nation. For now, the department is boosting private sector engagements to enhance public-private efforts in the housing sector. Now, despite the ongoing pandemic, majority of employers are still willing to raise salaries by an average of 5.6% this year. This is according to the latest salary budget planning survey report released by Willis Towers Watson. The study found that over 82% of companies will be increasing their workers' compensation this year. However, this is the slowest pace in over a decade as companies remain cautiously optimistic during the global crisis. The country previously logged a 5.7% hike in 2020 and a 6% increase in salaries in 2019. The global advisory company said for the past 10 years, the average salary raise hovered around 6%, but the pandemic forced companies to be more modest in budget planning this year. The WTW also noted that most companies in Asia Pacific have also lowered their 2021 average salary hike projections. And that's a first look into the business day. Today's Tuesday, March 9, 2021. Catch Business World Live for the market close. It's at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, and stay safe, Philippines. We are One News.